Hi everyone, I'm John Miller, CPA, and in this video we're going to discuss inheritances. I often have clients come to me and say, John, I just inherited some money from my aunt. Is that money taxable? Well, you know what my answer is most of the time. It depends. And it does, because there are several different kinds of money and property that can be inherited. So let me go over a few of the things and show you how this all works. First of all, there's several kinds of taxes. There's an estate tax and there's income tax. If you inherit some money, you're not going to have to worry about the estate tax. If there is estate tax, that will be handled at the level of the estate. And let me just go into what an estate is. An estate is an entity that's formed when a person dies. So let's just say, for argument's sake, that your father dies. Well, an estate will now be created for your father, and there will be somebody that will be put in charge of the estate. They're known as an executor. And the executor will manage the affairs of the estate until all the property has been distributed to the beneficiaries or the heirs. Now, right now, there is no estate tax on the federal level on estates that are valued at less than $5 million. So most estates will be less than that, and we won't have to worry about estate taxes. Now, you may have to worry about it on the state level. Here in Georgia, where I am, there is no estate or inheritance tax, but there are a lot of states that do have a tax. For example, New York has an estate tax, and I believe Pennsylvania has an inheritance tax, and a lot of states have state taxes that may have to be paid. But in any case, if you're the one inheriting the money, unless you're the executor of the estate, you won't have to worry about any of that. The only thing that you're going to have to worry about is whether or not the money that you inherit is taxable. Now, it depends on what kind of money you inherit. If you just inherit money from the person's savings account, or from some stocks that have been sold, or let's say the person owned a house and the house is sold, and some of the money is distributed to you, that money's not going to be taxable, because all that is part of the person's savings. But if you inherit retirement money, such as money from a 401k plan or from an IRA, that money's going to be taxable, because it would have been taxable to that person had they pulled the money out while they were alive. Now, another thing that could happen is, if you're the beneficiary of an IRA, you have the option of rolling that money into your own IRA and avoiding the tax on it until you become older and take the money out. Now, the other thing that happens is that sometimes, if you inherit the money, let's say from a parent or a grandparent, and the person's over 70 and a half, they have to take required minimum distributions from their IRA. Now, basically, when you inherit money from a person's IRA, you basically step into that person's shoes. If that person had to take annual distributions from their IRA, you might be able to roll it into an IRA into your own name if you're a beneficiary, but if you do that and they had to take annual distributions, you're going to have to take annual distributions as well, although the distributions will be over your life expectancy instead of the life expectancy of the person who died. Now, another thing that happens is, let's assume that you can't roll the IRA over and you just have to pay the tax on it. You'll have to pay the income tax on it, but there's no 10% penalty on that money, because it's due to the person's death. It's due to an inheritance. So even though you'd have to pay the tax on it, there's no 10% penalty. Now, another thing that can happen is you can inherit the person's house, or you may inherit stocks or mutual funds or other securities investments from that person. Instead of receiving the money, they might just give you the shares of stock. Well, what happens there is you have what's called a step-up in basis. Let's say, for example, that you inherited some stock from your grandfather after he died. And let's just say, for argument's sake, that he had bought AT&T stock 50 years ago. Well, in 1984, AT&T was broken up. They basically dismantled it into the 7 Marbell companies, and the companies they split, and the stock split, and it merged, and they bought and sold. And if you had to go back to figure out what the stock was worth when the grandfather bought it, you would never be able to figure it out because he bought it 50 years ago, and I'm sure all the paperwork's been thrown out, and there's no way that we would be able to figure it out. We'd have to guess. But the good news is you don't have to worry about that because there's this idea of a step up in basis. And basically what happens is you either take the grandfather's death, or the date of his death, or 6 months from the date of his death. You can choose which date you want to use, and whatever the market value of the stock was on that date becomes your cost basis, or it's like the price you paid for the stock. So you don't have to worry about when the grandfather originally bought the stock. All you got to know is what was it worth when he died, or 6 months from the date he died. And the chances are it's worth more then when he died than it was when he bought it 50 years ago. So you don't even have to worry about how much the stock went up through his lifetime. All you need to know is what was it worth when he died. And then if it goes up further than that and you sell it, you would have a capital gain. If it went down, you would have a capital loss. Now, here's another example. Let's say you inherit your grandfather's house. Well, once again, it would be the market value of the house on the date of death, or 6 months from the date of death. And you probably would end up not owing any tax on that because, well, first of all, chances are the house would be paid off. If it's your grandfather, he might have had it for years, and he might have just paid it off over his lifetime. So now when you sell the house, you don't have to worry about a mortgage, but you're probably not going to make money on it because usually when in an estate, when somebody dies and they're trying to sell the house, more often what happens is there's several beneficiaries. And when you sell the house, the money's going to be split among the beneficiaries. And most of the people just want the house sold. They don't really want the house. So what's going to happen, and nobody else really wants to bother fixing the house up so it can sell for more. But most of the time, when somebody dies, the executor wants to get rid of the house because all the beneficiaries want their money. So chances are the house is going to sell for a little bit less than what it was worth on the date of the person's death because the people in the estate are just trying to get rid of it. So in any case, if it's coming, so to sum it up, if it's coming from just the regular savings of the person, or if it's just the person's property, there's no tax on the inheritance. But if it comes from a retirement account, it's usually taxable unless you are a beneficiary and you can roll it over. And at some point in your life, you would have to pay tax on it anyway. And stocks and bonds and interest would be taxable if they're distributed to you and income is earned on them, or they go up on value. That's the other thing. If you inherit stock and then you hold the stock and the stock pays dividends, of course those dividends would be taxable because you now own the stock. So that's how inheritances are taxed. And if you have any questions, feel free to call 770-419-3399. My email account is johnmillercpa@gmail.com, and you can also feel free to visit my website, www.incometaxpreparation.com. Thank you very much for watching, and I will see you in my next video.